We're still talking about Q3 performance with Morningstar. My guest from Cape Town, David O'Leary, Director of Fund Research at Morningstar South Africa. And as per usual, the usual suspects, Quibby and Roland, joining us in our Joburg studios. Quibby, let's take a look at the best allocation funds so far. But first off, just explain to us what allocation funds do, particularly in an environment like this.
Okay, well, I mean, an allocation fund is really what we call a flexible asset allocation fund. It's a fund or funds which allow for the inclusion of different asset classes, so equities, bonds, property, cash, even global asset classes. Obviously, of particular interest here is Regulation 28, the fact that they have to have broad-based compliance with the Pension Funds Act. Let's just look at the kind of who the star performers were in the allocation market. Now, obviously, here what you're trying to get right is you're trying to get your asset classes right. That's the first thing. And then the second thing you're trying to get right is you're trying to get your stock picking right. So those are two kind of elements that you need to be juggling as a fund manager in order to make sure that it works well. And you can see there, the best manager over the quarter there is Battalier Flexible, the Battalier Flexible Fund with a benchmark of CPI managed by Kevin Williams. The 1 year number there, 24.4. I mean, that's obviously a great number. And then it's followed there by the Grindrod Pacer Fund. There, the benchmark being that of CPI plus 5. Let's just move to the worst allocation funds, and there you can see what those look like. Now, worst allocation funds, right at the bottom there, you see the RECM Flexible Equity Fund. We know that they've been sitting with quite a bit of cash. I mean, this is again a very good fund manager. I mean, this is a manager with a solid long-term track record, deep value understanding of the market.
But is 7.5% good enough for 3 years?
Well, I mean, again, I think, the hurdle rate here is Aussie plus 2.5, for a flexible asset allocation fund, which I think is quite a high watermark in order to get it. You're right. The 3 year numbers, 7.5% per annum, every year. Yeah, there's funds that you could have chosen that have done much better.
Certainly, I mean, 20%, almost 30% if we look at the funds we've looked at.
Yeah, we mustn't forget that the pure equity kind of categories we've looked at so far are very volatile, and interesting that at least the best performers in the allocation funds have had similar returns to these high risk categories, but they've got much lower risk. So you've had a much smoother ride, and you've had the same returns that you would have had from a pure equity manager with a much more diversified portfolio.
Yeah, I mean, for me, if you look at RECM, long-term track record is in place. You've got serious skill at the asset manager. The fact that they're at the bottom end of the rankings over a short period of time signifies that they're positioning the fund in order to try and achieve something, at some point. David, let's just throw it to you. Have you got any comments here on the allocation funds?
Well, I mean, just to expand on your point, I think it's fair. Samantha had mentioned, well, 3 years, isn't that quite a long period to be producing lackluster returns? And the short answer is no. It's not really all that long a period. It really depends on market conditions, and a manager can be in or out of favor due to no fault of their own for extended periods of time. I mentioned the Warren Buffett example. Throughout early 2002, 2003, all the way till the the financial collapse, if you had, as a manager, took a big bet on resource stocks, you would have done phenomenally well. Does that mean that you're a very skillful investment manager, or that you just got lucky and made one call right? I mean, I don't know the answer, but you can look good or bad for really extended periods of time, and it doesn't mean that you're a good or bad manager. And that is the difficulty of trying to parse out whether a manager actually is demonstrating skill or luck. But
David, then what is the optimal?
A 3 year lackluster performance number is not a reason to panic.
What is the optimal cycle that you would be looking at fund performance then? Because obviously, as you say, 3 years a little bit too short. Some say at least minimum 5 years. What is the optimal cycle?
I mean, I think it really is case dependent. So, in long-term sort of trending markets like we had through 2003 to 2007, 2008, it was really the story of resources, and there was trends that persisted. So, in that environment, if one call can lead a manager to top returns, then I'd say it's too short a period. That said, if throughout a 3-4 year period you had a lot of sort of dramatic changes and big pivotal events that swayed the markets both ways, then I might give more credence to how a manager performed and navigated through that, or how their style performed throughout a period of 3-4 years where there was a lot going on, rather than just one broad thematic driver. So, but 5-6 years is sort of the minimum where I start to consider it a long enough period of time.
Let's look at those foreign managers. Let's look at how those have performed. If you have a look at your screen, you'll see foreign equity. These are kind of the best performing managers. You see right at the top there, Prescient Africa Equity Fund with their quant process. Massive performance there, 23% relative to the rest of them that kind of follow in its wake. And if you have a look at the worst performing categories there, you could have a look right at the bottom there. You see the Discovery Global Equity Fund. And I mean, that is a fund which is managed by Investec on behalf of
Discovery.
Discovery.
I'm just going to jump in there.
And I apologize for standing on my words there.
Don't apologize, Quibby. You don't have to apologize for that. But let's talk about foreign equity funds. What stands out for you, Roland?
Well, it's interesting that the best performing fund within foreign equity is the Prescient Africa Fund, and the worst performing foreign equity fund is the Stanlib Africa Fund. So you got you would have thought that the Africa effect would have outperformed the global kind of foreign effect, but clearly it was a bit of a stock picking kind of game here within Africa.
Yeah. Any comments from your side, David, in terms of these foreign equity funds?
Well, I mean, I think that last point about the Africa funds performing very differently, I think is interesting. It's a vast continent with very disparate countries, and despite the fact that they typically get lumped together as Africa, I think does a disservice to investors in sort of considering it all one big place that's similar. Obviously, there are very different returns being produced by the different stocks and countries.
Yeah, I mean, sorry, Roland corrected me there. It's actually not the Discovery Global Equity Fund, which is the worst performer. It's actually the Stand-Up Africa Equity Fund, which is a bottom-up process relative to the Prescient process, which is obviously a top-down, or rather a quant process. Just have a look quickly. Let's have a look at the fixed income funds. So you can look there. Right at the top is Mark Leroux's fund and Tanya Miglietta's fund. You can see the quarter returns there for Coronation Bond. You can see a fairly concentrated field as far as your top performers were concerned. Great 1 year numbers as far as these are concerned. It kind of just shows again the environment that we're in as far as fixed income is concerned. And if we move to the worst performers, you can see right at the bottom of the scale there, you see Ind Equities Income Provider Fund, which is really a fund of funds at the end of the day, or multi-managed fund. Alan Gray, Momentum, Stand-Up are the kind of managers that are within that space there.
David, I think this is a bit of a feather in your cap, because if we look at the best performing domestic fixed income funds, they all got 3-4 star kind of Morningstar ratings, and if you look at the worst performing fixed income funds, they got 2 and 1 star ratings. So something seems to be working there.
Yeah, I mean, ideally, like the star rating is a report card of how well a fund has done in the past, and so if the past performance of a manager is any indication of how they'll do going forward, then the star rating should hold. That sometimes holds and sometimes doesn't. But it's it's an interesting piece of information, I think, nonetheless.
Certainly does hold in this instance. Before we wrap this up, David, any closing comments from you with regards to Q3, or I suppose your time in South Africa, some of the key themes that you're starting to pick up from the fund management industry here in South Africa?
One thing that is kind of unrelated to the short-term performance numbers we're talking about, but one thing that struck me was, as a North American, or I'm Canadian myself, but even Americans, it would be very rare and probably seen as very risky to allocate any significant percentage of your portfolio to South African equities or South African fixed income investments. And being here, you get this. You see where the money is flowing, and it's overwhelmingly to domestic assets and equities in particular, and the allocation funds in particular. So I just find it interesting that the perception of risk is very different depending on where you are, but you're seeing South African investors being rewarded for investing at home, because the returns that are being generated here are significantly outstripping what we see in the developed markets.
Well, we hope you're feeding that information back to your colleagues back in North America, as you say. David, good as always to have you on the show. We'll see you at the end of Q4.
Thank you so much.